It's Monday, August 5th, and I want to explain to you why everyone is throwing up their hands and panicking about the stock market in the US. There's three key drivers here, and it's all coming together, and I want to explain what's going on and then also explain the implications for tech. So here's the drivers. Number one is what we call the yen carry trade. I actually lived through the first instance when this became unstuck in 1998 in Asia. It's a very vivid memory for me. It's a really big deal when this gets unstuck. So, brief history. Since 1990, about the Japanese government has maintained, broadly speaking, about a 0% interest rate on the yen. And the reason for that is because they want to reinflate the economy. And so Japanese interest rates have been so low for so long that institutional investors have taken to borrowing in yen because it's essentially risk-free money at their scale and investing in US equities and arbitraging the difference. So there's a lot of buying pressure coming from that trade for a very long time. It's really consistent. And when it comes unstuck is basically when the Japanese government decides to raise interest rates, which it has once or twice. It did in 1998, and it did this week. In fact, it was an unexpectedly sharp rise, which is part of what's driving people up the wall. Right now, about $4 trillion in U.S. equities are attached to this Japanese yen carry trade thing. It's starting to get unwound as traders have to go back and make sure they can cover their losses. Because at the end of the day, there's a double dynamic here. When the interest rates rise, it's not only not risk-free anymore, it is also increasing the value of the yen. It's appreciating the currency. So if you're handling multi-currency swaps, it means that you're potentially unable to sell your U.S. equities position and cover all of your yen debt because the yen's worth more now relative to the dollar. That probably sounded really complicated. It is one of the pieces. Here's the other two briefly. The AI capex problem, which I have talked about on this channel a fair bit. Fundamentally, we're spending a ton of money on capital expenses for AI, but the return on investment window is way longer than the street wants. It is not 12 to 18 months. It's going to be years out. And that's not me saying that. That's big corporations saying that in their earnings reports. And that is scaring the market that was really hoping that AI would produce an earlier boost to earnings. And instead, they're seeing it produce an earlier boost to capital expenditures on the wrong side of the balance sheet. All right. And then the third factor, no surprise, election year, things tend to be really dramatic. The geopolitical situation right now is very unstable as well. And so that just adds to a sense of uncertainty. When you put all three of these things together, and then you sort of light the tinder with this unexpected interest rate rise from the Bank of Japan, things get exciting really quickly. And that is exactly what happened over the weekend. And that is why most people are expecting that this week in the equities markets is going to be really red. So what does that mean for the IPO window, for the exit window, for tech in general? So I'd like to divide this up into a couple of maybe three different takeaways. One for broad tech, which is like tech outside of the really big tech companies, like if you work in tech at Walmart. One is around how we understand the tech startup market and exits. And the last one is for big tech in particular. All right, so broad tech first. In general, the thing, if you work in broad tech, like if you're in IT support at a bank, if you're a product manager who is working with a large retail company that isn't a tech company, these things matter less than the larger signals in the economy around whether or not the economy is headed into recession. And right now, those lights are flashing yellow. We don't really know what's going to happen. We typically learn about whether we're in a recession after we're already in it, which is part of what makes people nervous. So if you're looking at what is going to drive your equity package, look at the broader economic signals because that is what's going to be most influential for the earnings and revenue for your particular company. Now, if you're in startups, this whole uncertainty window, all of the red in the markets this week probably, is going to make it even harder to plan for a exit. Now, that won't matter if you're seed stage, if you're Series A, you don't really care. You're way too far out from an exit for it to matter. But if you are Series C or later, and you were thinking about a particular 3 or 4 month window, 3 to 6 month window for exiting, this is probably going to shift that timeline out, which means the value of your equity is going to shift out as well. That is something I have seen over and over and over again since the shift in the markets in 2022. And I think one of the things I am looking for to see if tech is getting back to healthy is if late stage companies can reasonably plan for exits. Because right now, that has just not been the case for a couple of years, and it's sticking up the markets overall. Finally, for big tech, if you have equity in big tech, it's a tough time. So long story short, basically, big tech is getting pummeled from two directions at once. The investment in equities that the yen carry trade unlocked and sort of a lot of the institutional buying in the market may turn into some degree of selling over the next week. It's just not going to be a good time for a week or two here. And when you have broader concerns around recession that are also starting to pop their heads up, and concerns around capital expenditures at the very companies where you own equity, it adds up to a really challenging combination. I'm not here to tell you what to do, but I would say this is one of those times where you have to have a long-term view of the value of your career and the value that you're unlocking and sort of where your equities can go long-term. Because in the short term, I don't think that things are going to look very pretty at some of these big tech companies. None of them are necessarily strangers to drawdowns. So if you look back at the history of, say, Amazon or Netflix or other big companies, they will have these big drawdowns. It's happened before. It may happen again. We'll see. But keep in mind that overall, what you're doing when you work at a company is you're making a bet on that company's long-term future. And just remember the long term right now. Remember the long-term future you're looking to unlock, because things will probably get rough this week. And that, hopefully you understand why now. Hopefully you understand the implications for tech. I'm really looking for a little bit more predictability in the markets in 2025 to unlock that late stage IPO window. And I think that's going to help things out. It will also help if in 2025 we can get some of these big companies saying they're starting to see revenue coming in from AI. Those two factors would be huge. All right. Best of luck this week.